You've probably seen the moving average indicator before, right? It's one of the most popular tools in trading. But here's the thing. It's also one of the most misused. So many traders see that simple line on a chart, jump in, and then get totally chopped up by false signals. Well, today, we're going to dive into a strategy that helps filter out all that noise to find much more consistent and hopefully profitable results. Let's get right into it.
So here's our game plan. First, we'll quickly cover the basics of what moving averages even are. Then, we're going to look at why the most common ways of using them so often lead to losses. After that, we'll get to the good stuff, the two crossover strategy. We'll show you exactly how to put a trade on with it, and then we'll wrap it all up with the key takeaways.
Okay, first things first. Before you can really trade with any indicator, you've got to understand what it's actually trying to tell you. So let's build that solid foundation right now.
At its heart, a moving average is just what it sounds like. It's an average of the price over a certain amount of time. But its real magic is how it smooths out all that chaotic up and down price action. So instead of getting lost in all the noise, you get one single clean line that helps you see the real underlying trend.
Now, you have to know that not all moving averages are the same. A short-term one, say a 20 period, is like a sprinter. It reacts really fast to price changes, giving you a feel for what might happen next. On the other hand, a long-term one, like a 200 period, that's more like a marathon runner. It moves much more slowly, and it tells you about the market's huge, overarching direction. It's all about the time frame you're looking at.
Okay, so we know what they are. Now let's get to the really crucial part. Why do so many people lose money with them? This is where, honestly, most traders trip up.
And that really is the big question, isn't it? Their simplicity is kind of deceptive. The truth is, the most common ways people use them are deeply flawed, mainly because they totally ignore the market's context. Let's break down two of the biggest offenders.
First up is the breakout strategy. Now the logic? It seems pretty sound. Price has been going down, staying below the moving average. Then all of a sudden it punches right through it. The natural assumption is, hey, this must be the start of a new uptrend. So traders pile in and buy. But here's the trap, and the source material puts it perfectly. We should avoid relying on breakouts because false breakouts happen all the time. Seriously, using a breakout as your only reason to enter a trade is just a recipe for getting stopped out over and over again.
Okay, so the second flawed approach is the simple crossover. This is where a trader uses two moving averages, right? A fast one and a slow one. The idea is, when that speedy, fast line crosses above the slower one, it's a golden cross, and that's your immediate signal to hit the buy button.
The problem here is pretty simple. Moving averages are logging indicators. By their very nature, they're looking in the rear-view mirror. They react to what's already happened. So by the time that crossover signal finally shows up, the price has often already gone up a lot. You end up buying late, your stop loss has to be miles away, and your risk to reward is just terrible. So, if breakouts are unreliable and simple crossovers get you in way too late, what's the alternative? Well, this brings us to the core of today's explainer, a strategy that uses the same exact signals but adds a critical layer of context.
You know, the secret here isn't some brand new, complicated indicator. Not at all. It's about a simple but really powerful shift in how you think. Instead of just blindly reacting to every single signal, we're going to be more like a detective. We're going to look for evidence first and wait for the market to prove to us that its signals are actually trustworthy right now. And this is it. This is the simple rule that makes the whole thing work. Before you even think about placing a trade, you have to look back and analyze the last two crossovers that happened on that chart. How they performed, that's your guide.
And what's great about this is how it turns that rule into a super clear decision-making tool. If you look back and see that the last two signals failed, meaning they would have been losing trades, that chart is basically screaming at you that it's unreliable. What do? You do nothing. You just walk away. But if both of the last two crossovers were winners, well, that's your green light. The market is telling you that it's respecting these signals, and there's a good chance the next one will work out too.
Okay, so you found a reliable chart. The last two signals worked like a charm. What's next? Let's get into the execution and see how this all comes together into a complete trading plan. Here it is, your 4-step checklist. First, you verify. You confirm those last two crossovers were profitable. Once you've done that, you enter on the very next crossover signal you get. Immediately after, you protect your trade by setting a stop loss just past a recent peak or valley. And finally, you set your profit target at 2 times your risk. It's a clear, repeatable process from start to finish. We've covered a whole lot of ground. So let's boil this all down into the most important rules you need to remember, plus one absolutely critical warning.
All right, let's recap the rules that make this whole thing tick. First, we're using the 20 and 50 period simple moving averages. Second, you go hunting for a chart where the market's already proven that the signals are working. Only then do you act on the next signal. And finally, the 2 most important rules of them all: you never, ever trade without a stop loss, and you always aim for a take profit that's at least twice your risk.
And this right here is probably the most important thing to remember. This strategy is all about the probabilities, not predicting the future with certainty. Just because a chart has been reliable doesn't mean it's going to be reliable forever. Markets change. And that is precisely why risk management is not optional. That stop loss is your safety net for when the pattern inevitably breaks.
And that leads us to our final thought. This strategy works best in markets that have a clear, consistent personality. It's designed to filter for that reliability. So I'll leave you with this question to think about. What kind of real-world event, like a big news announcement or a sudden shock to the system, could instantly turn a perfectly reliable, trending chart into a choppy, unreliable mess? Understanding that is the next step to mastering any strategy.